Swayam Prabha. Digital India. Educated India.
Yoga Karmasu Kaushalam.
Friends, Namaskar. My name is Dr. A.C. Sardar, retired professor, SD School of Commerce, Gujarat University, Ahmedabad. At present, we are dealing with final accounts of sole proprietary concern. In that, we will see today preparation of final accounts part 2. Dear friends, we are studying about final accounts of sole proprietary concern, and in first part of it, we have studied one illustration on preparation of final accounts, under which we have prepared trading account, P&L account and balance sheet. But these final accounts are prepared without adjustments. Number 2 is closing stock is ascertained from stock register and valued either at cost price or market value, whichever is less as per concept of conservatism. When no other information is available for value of closing stock, it will be assumed that both cost price and market price are same. Number 3. Before preparation of final accounts, we have recognized all accounts of debit and credit side of trial balance and their place in final account is determined. Gross profit and gross loss are transferred from trading account to P&L account. Net profit and net loss are transferred from P&L account to capital account. Balance sheet can be prepared in two forms. One is in order of liquidity and number 2 in order of permanency. We have prepared balance sheet in the order of liquidity. Liquidity order focuses on cash conversion speed of respective asset. We have prepared balance sheet under order of permanency. Permanence order focuses on time period of respective asset. We will continue with the preparation of final accounts, but with some other important issues. In illustration 2, we have incorporated the effect of GST in final accounts. Now friends, let us understand what is GST. There are two types of taxes, direct tax and indirect tax. GST is indirect tax. Friends, let us see the further explanation of GST. It is very interesting. See, the point number what is written in that? It is a destination based tax on consumption of goods and services. Now, in the bracket what is written, try to understand that. It explains that tax is charged on the basis of place. So, place of supply of goods and services is very important in GST. Number 2, it is proposed to be levied at all stages right from manufacturing up to final consumption with credit of taxes paid at previous stages available as set off. And number 3, in a nutshell, only value addition will be taxed and burden of tax is to be borne by the final consumer. Let us see types of GST. Number 1, state goods and services tax. Every state has its own GST Act. Number 2 is Union Territory Goods and Services Tax. Every UT has its own GST Act. Third one is Central Goods and Services Tax. And the fourth one is Integrated Goods and Services Tax. Friends, let us have a look on structure of GST. Structure of GST is divided into two parts. The first one is intrastate supply and second one is interstate supply. Friends, when there is a intrastate supply, two GSTs are applicable, CGST and SGST or UT-GST. But in case of interstate supply, IGST is applicable. Let us understand with some illustration. We will understand applicability of GST on the basis of place. As I explained to you that in a case of GST, the determination of place is very important to determine GST liability. Here in the table, we are given certain transactions. Have a look on that. Transaction place is given to you, place of seller and purchaser is given to you, type of supply we can decide, and which GST is applicable, that also we will see. For example, number 1, we have transaction within the Gujarat, means the seller and purchaser are from Ahmedabad and Baroda respectively. In this case, intra-state supply is there, therefore, CGST and SGST are applicable. Let us take second case. Both are either from Ahmedabad or Baroda. In the same way, intrastate supply will be considered and CGST and SGST are applicable on it. Second case is given to us outside Gujarat, Ahmedabad and Mumbai. There are two different states and automatically it will be your interstate supply, and here we have to apply IGST. Let us take another example. Transactions are within the Rajasthan. Seller and purchaser are from Jaipur and Bikaner. So, both are from the same state, automatically intrastate transaction. So, CGST and SGST are applicable. In another case, both are either from Jaipur or Bikaner. This is also intrastate, CGST and SGST are applicable. Fourth is given to us outside Rajasthan, Jaipur and Indore. Jaipur is in Rajasthan, Indore is in Madhya Pradesh, so it is your interstate, so IGST is to be applied. Then another illustration is within Union Territory, both are from Pondicherry, that is also intrastate, CGST and UTGST is to be applied. Sixth case is outside Union Territory, Pondicherry and Chennai, that is interstate supply, so IGST is applicable. Friends, after having information about GST, let us study their accounting treatments. Input GST is paid at the time of purchase and output GST is collected at the time of sales. So, business entity will have two accounts, input GST and output GST. There is a provision in GST for net payable or receivable GST. If input GST is more than output GST, difference is recoverable GST from government. And if input GST is less than output GST, difference is payable GST to government. This net effect of GST is known as set-off of GST. Now, let us understand what is set-off of GST. Goods and services tax GST paid on purchases of goods and services or both are known as input GST. This paid GST is input tax credit. GSTs collected on sales or supply of goods and or service or both is known as output GSTs. As per provision, input GSTs are set off against output GSTs. Friends, let us understand input tax credit with the help of one example. Mr. X of Ahmedabad has purchased goods of rupees 5 lakh from Y of Baroda and 18% GST is paid on it. He has sold the entire goods for rupees 7 lakh to Z of Rajkot and 18% GST is recovered. Explain the treatment of payable and receivable GST. Let us see the solution on it. Friends, it is intrastate purchase and sales. All parties X, Y and Z are from Gujarat. Thus, 9% CGST and 9% SGST shall be applied on purchase and sales. First of all, we will pass journal entry in the books of X. Here, X has purchased the goods of rupees 5 lakh. So, purchase account will be debited by 5 lakh. At the same time, we have to pass the entry for GST also. Input CGST account debited by 45,000. Input SGST account will be debited by 45,000 and Y's account will be credited by 5,90,000. The same goods is sold by X to Z. So, here Z account will be debited along with the effect of output GSTs. So, Z's account debited by rupees 8,26,000 to sales account 7 lakh, to output CGST account 63,000, to output SGST account 63,000 rupees. Now, friends, here net GST calculation is to be done. we have collected CGST and SGST from customers, means through sales, 63,000 and 63,000 respectively. At the same time, we have paid 45,000 for CGST and SGST respectively. So, collected amount is more, paid amount is less, so remaining 18,000 in each case is payable to the government. Now, in the books of accounts, net amount of GST will be shown. Here it is payable, it will be shown in liability side of the balance sheet. Now friends, in GST there is a specific order to set off GST. Let us study that part. As we have studied that, keeping in mind the place of supply, respective GST is applied. A specific order of setup of GST is to be followed during filing GST return. Let us see the order in which it can be set off. Input tax credit means the goods which we have purchased. In case of input tax credit, first part is CGST. From that, first we will deduct the CGST, then we will deduct IGST, and no surplus is allowed for SGST. So, here once again let us understand, from input CGST, first output CGST, and from the remaining balance output IGST will be set off. The remaining balance cannot be used for output SGST. Let us see input tax credit on SGST. The first we will take the benefit of SGST, then IGST, but not allowed CGST. Let us understand once again. From input SGST, first output SGST, from the remaining amount output IGST can be set off, CGST is not permitted. In third case, we have IGST. From that, first we will deduct IGST. If any amount is remains surplus, we will deduct CGST, and here we have the provision to deduct SGST also. From output IGST, first output IGST, from the remaining balance CGST shall be set off, and last if any balance remain, then SGST is permissible to set off. Friends, whenever in the final accounts the point related to GST is included, please keep in mind two important points. Number one is, when the final accounts are prepared, the balances in GST account should be set off in the discussed order. Number two, if any balance remain left according to its balance, that will be shown in balance sheet accordingly. If respective GST has credit balance, it would appear a liability side. It means output GST is greater than input GST. And in case of debit balance, respective GST account would appear at asset side. In bracket we have mentioned that input GST is greater than output GST. Now friends, we will see GST based illustration. We will see illustration number 2. You are provided trial balance of Mr. Contractor at 31st March 2025. You are asked to prepare final accounts from the given balance sheets. See friends, here capital is given to us of rupees 3 lakh. So, it would appear in the balance sheet at liability side. You are given the opening stock 60,000 rupees. It would appear debit side of trading account. Cash at bank 20,000 rupees in balance sheet asset side. Cash in hand 10,000 rupees asset side of balance sheet. Machinery 2 lakh asset side of balance sheet. Furniture 26,000 asset side of balance sheet. Purchases 4 lakh debit side of trading account. Wages 1 lakh debit side of trading account. Carriage inward 66,000 debit side of trading account. Salaries 1,40,000 debit side of P&L account. Discount allowed 8,000 rupees debit side of P&L account. Discount received 10,000 credit side of P&L account. Advertising 1 lakh rupees debit side of P&L account. Office expenses 80,000 debit side of P&L account. Sales credit side 10 lakh rupees of trading account. Then sundry debtors asset side 1,80,000. Sundry creditors 94,000, that is in liability side of balance sheet. Then after friends, we are given GST paid and GST recovered. In green shadow you are given the input CGST and SGST, and in yellow shade you are given IGST of rupees 20,000 pertaining to input CGST, then input SGST 20,000, input IGST 30,000, then output CGST 16,000, output SGST 16,000, output IGST 20,000. So, total of trial balance is 14,60,000. And finally, we are given the value of closing stock on 31st March 2025 rupees 1 lakh. Now, friends, we will see the solution. This solution does not contain any adjustment, thus, we will commence with the balances of trial balance. As we have discussed that the first of all, we will recognize the accounts of debit side of trial balance, and subsequently, we will record them at their appropriate place, that is either debit side of trading account or debit side of P&L account or asset side of balance sheet. In second stage, we will recognize the accounts of credit side of trial balance, and subsequently we will record them at their appropriate place, that is either credit side of trading account or credit side of P&L account or liability side of balance sheet. In this illustration, we have new point, that is about different types of input and output GSTs. In final accounts, we have to disclose net amount of GST. For that purpose, set of calculation are to be done. Here, we will set off GST. We have paid GST in case of CGST, SGST, IGST rupees 20,000, 20,000 and 30,000 respectively. We have collected GST from our sales 16,000, 16,000 and 24,000 for CGST, SGST and IGST respectively. So, we will have balance of 4,000, 4,000 and 6,000. It is a debit balance because paid is more than the calculation. So, it is our recoverable amount from government. So, it would appear at asset side of the balance sheet as a recoverable GST from respective government. Now, friends, we will see our trading account of Mr. Contractor. As we have discussed, the opening stock is always appearing at the debit side 60,000. Then we will disclose 4 lakh rupees of purchases, wages of rupees 1 lakh, carriage inward 66,000. Credit side we will have sales of rupees 10 lakh and closing stock of 1 lakh. Final total of credit side is more than the debit side, and that is why we have difference of rupees 4,74,000 as the gross profit. This gross profit will be transferred at the credit side of our P&L account. At the credit side of P&L account, we have disclosed gross profit rupees 4,74,000. At the same time, we have received discount of rupees 10,000 also. Now, let us have a look at the debit side of P&L account. Salary expense we have of rupees 1,40,000, discount allowed 8,000, advertising 1 lakh, to office expenses 80,000. Same way, here we have higher total of credit side than the debit side. So, differences appear at the debit side 1,56,000, and that is our net profit, and this net profit we will add in the capital of honor. And now, let us have a look on the balance sheet. So, in the balance sheet liability side, we have capital of rupees 3 lakh and we will add profit of rupees 1,56,000. We are not given any amount pertaining to drawing, so we will not consider it. So, total capital at the end of the year of a honor is 4,56,000. Sundry creditors are of rupees 94,000, and now we will have a look at the asset side. We have machinery of rupees 2 lakh, furniture of rupees 26,000, cash in hand 10,000, cash at bank 20,000, sundry debtors 1,80,000, closing stock 1 lakh, input CGST 4,000, input SGST 4,000, input IGST 6,000 rupees. In the total of balance sheet is 5,50,000. Now, let us see another illustration with small modification. Illustration number 3, you are provided trial balance of Mr. Atul at 31st March 2025. You are asked to prepare final accounts from the given balances. We have trial balance which is ending as on 31st March 2025. We are having capital of rupees 6 lakh, drawings rupees 60,000 to be deducted from capital. Opening stock is given to us of rupees 1,20,000 would appear at debit side of trading account. Then we are having bank balance, that is in balance sheet asset side, cash balance asset side of balance sheet 20,000 rupees, plant and equipments 3 lakh in balance sheet asset side, patent and trademarks 1 lakh asset side balance sheet, furniture 52,000 asset side balance sheet, investment 1,08,000 asset side in balance sheet. We have purchases of rupees 8,50,000 debit side of trading account. Then we are having purchase return of rupees 50,000 to be deducted from our purchases to arrive at net purchases. Then wages debit side of trading account 1,50,000, power 50,000 debit side of trading account, then carriage inward 1,32,000 debit side of trading account, salaries 2 lakh debit side of P&L account, rent rupees 80,000 debit side of P&L account, discount allowed debit side of P&L account, discount received 20,000 rupees credit side of P&L account, selling and promotion expenses debit side of P&L account, office expenses 80,000 debit side of P&L account, sales 21 lakh credit side of trading account, sales return 1 lakh will be deducted from sales to arrive at net sales. Then after we are having sundry debtors asset side of balance sheet, sundry creditors liability side of balance sheet, office electricity 14,000 rupees debit side of P&L account. Then we are having input CGST, input SGST, input IGST. Simultaneously we are having output CGST, output SGST, output IGST. As per our norms, we will show the net amount of GST in our final account. So, total of trial balance is 30,88,000 of both the side. Now, we are given the cost price of closing stock rupees 2,10,000, but its market price is rupees 2 lakh. Now, let us have a look on solution. In this illustration, we have cost price and market price of closing stock, and as per conservatism concept, price whichever is less will be taken into account. Thus, we will record rupees 2 lakh. We have information about input and output GST also. Thus, we will ascertain net GST. In our case, input GST, paid GST for CGST, SGST and IGST are rupees 16,000, 16,000 and 24,000. But at the same time, we have collected from our customer 20,000, 20,000 and 30,000 respectively for CGST, SGST and IGST. It is a credit balance because paid GST is less than collected GST. So, it is our payable amount to government. So, it would appear at liability side of balance sheet as a payable GST to respective government. In illustration 2, GST was recoverable one because input GST was greater than output GST, and in illustration 3, GST is payable, case is other way around. Now, we will have a look on trading account of Mr. Atul ended on 31st March 2025. First, we will see the items of debit side. Obviously, the very first item is opening stock of rupees 1,20,000. We have purchases of rupees 8,50,000. From that, we will deduct purchases and it is deducted 50,000 rupees and net amount is 8 lakh. Then after wages 1,50,000, power 50,000, carriage inward 1,32,000. We will have a look at the credit side. Sales we are given 21 lakh, sales return 1 lakh. So, net sales is of rupees 20 lakh. By closing stock we are having 2 lakh. The total of credit side is greater than debit side. So, difference is appeared at the debit side 9,48,000. So, this gross profit we will transfer to credit side of P&L account. Have a look at the credit side of P&L account. Gross profit we will transfer and it is transferred 9,48,000. Another item of credit side of P&L account, we have discount received 20,000. So, it is written over here. Now, we will switch over to the debit side of P&L account. Salaries we are having 2 lakh, rent we are having 80,000, discount allowed 16,000, selling and promotion expenses 2 lakh, office expenses 80,000, office electricity 14,000. Here also total of credit side is greater than debit side. So, difference is appeared at the debit side, that is 3,78,000, and it is our net profit, and this net profit will be added to the capital of honor. Now, we will have a look on the balance sheet as at 31st March 2025. We are having capital of rupees, opening capital of rupees 6 lakh. Net profit we have earned during the year 3,78,000, that comes to 9,78,000, but during the year honor has withdrawn 60,000 rupees. So, final capital at the end of the year is 9,18,000. Sundry creditors 2,48,000, output CGST which is payable 4,000 rupees, then output SGST payable 4,000, output IGST 6,000. Now, we will have a look at the asset side. We have plant and equipments of rupees 3 lakh, patent and trademarks of rupees 1 lakh, furniture rupees 52,000, investment of rupees 1,08,000. So, these are all fixed assets. Now, we will have a look on current assets. We have cash balance of 20,000, bank balances of rupees 40,000, sundry debtors 3,60,000, closing stock 2 lakh, and total of the balance sheet is equal of the both side 11,80,000. Now, we will have a look on summary. Now, friends, let us recollect our discussion, the summary of our discussion of part 2 of final accounts. We have observed the first item, meaning of GST. It is Goods and Services Act applicable on supply of goods and services, and both it is indirect tax. Then we have observed types of GST. Number 1 is IGST, that is Integrated Goods and Services Tax. Number 2 is CGST, Central Goods and Services Tax. Third one is State Union Territory Goods and Services Tax. In short form, it is SGST and UTGST. Number 3, applicability of GST, CGST and SGST for intrastate supply, CGST and UTGST for intra-UT supply, then IGST for interstate or inter-UT or supply between state and UT. Fourth point which you have observed was meaning of input tax credit and set off of GST, order of set off of GST, 2 illustration with closing balances of GST. Friends, practice makes man perfect. It is desirable for you to study more illustration to examine the final effect of GST on final accounts. Your regular practice makes you perfect with GST related issues. Thank you for joining us. We will meet soon with some other new issues of final accounts. Thank you.